These presentations highlight the financial analysis of Comfort Gloves and Top Glove Berhad, two leading glove manufacturers based in Malaysia. So first we have Comfort Gloves Berhad, which is established in 1993. The company specializes in high-quality medical and industrial rubber gloves exported to over 50 countries. And second, we have Top Glove Corporation Berhad, which is founded in 1991. It is the world's largest glove manufacturer, producing over 100 billion gloves annually for diverse industry. And both companies embody resilience and leadership in the highly competitive glove manufacturing industry, which is the focus of our analysis today.
Analysis ratio. In this part, there is 14 ratio that I'll be explaining its meaning. So the first one will be the current ratio. When the current ratio is higher, it means that it rises with the time, may be a sign of a stronger liquidity and could be the result of improved asset management or a greater cash accumulation. Second, acid test ratio. A greater ratio indicates a better liquidity overall financial health of the business. The third one will be average collection ratio, which indicates the business of collecting payment more slower than the collection period is long. When the account received turnover increased, typically it indicates that the business is doing well financially and is collecting its debts effectively. Inventory turnover, which tells us that the corporation sells its product much more quickly. And for the sixth one will be the debt ratio. A higher debt ratio indicates a company may take more debt than it affords to pay back, and it is highly indebted. For the earned time interest, when a business that generates, it is less harassed and operates more effectively. Total assets turnover shows that a business is working efficiently, since a ratio shows that it is more earning per dollar on an asset. And a fixed asset turnover, when a higher fixed asset turnover, it indicates that a company has effectively increased sales through its fixed asset investment. For a margin of gross profit, a business that has a high gross profit margin is making more money than it's spending on its cost of goods sold. And for a lower gross profit margin, it means that when a business has a low gross profit margin, is spending more money than it's making. A greater operating profit margins. A greater operating profit margin allows a management more leeway in the setting price, since it indicates that a business has a fewer fixed expenses and a stronger gross margin or revenue that are growing more quickly than its costs. A larger net profit margin indicates that a business can efficiently control costs or charge a price that is much greater than its cost of a good and services. For return on equity, which indicates how well a company management use its equity capital to generate revenue and growth. Operating return on asset, it means that a company is increasing its profit with each dollar that invests in the company in total asset. Thank you.
Comfort Glove demonstrates strong liquidity, with higher current and asset test ratio, reflecting its ability to handle short-term liabilities efficiently. It also shows slightly better fixed asset turnover and gross profit margin. However, the glove profitability and efficiency with superior net profit margin, inventory turnover, and return on equity, indicating robust operational performance, which Comfort Glove is financially prudent. Top Glove lead in overall profitability and asset utilization.
Comfort Glove Company has a strong financial performance with a good liquidity shown by the current ratio of N and asset test ratio. However, improvements are needed in the customer debt management, as the day collection period could cause the cash flow issue. The inventory turnover ratio of also suggests a better inventory management is needed to reduce costs and avoid the shortage. Additionally, the operating margin could be improved by the investing in the automation and efficient production. With the changes, and the company can strengthen with the position and ensure the long-term success. Top Glove is performing well but has an area to improve. Its debt ratio is high, so the company should reduce financial risk by the reinvesting profit or exploring other funding options. The low fixed asset turnover ratio suggests a better use of asset is needed, such as upgrading technology and improving the maintenance, while the inventory turnover ratio is strong. Better supply chain planning is needed to avoid the stock shortage. So, the low gross profit margin of the shoe production costs are high, and the company should cut costs and explore higher value product. By making these changes, Top Glove can boost profit and grow stronger.
Suggestion on suitable source of funds. For Comfort Glove can grow by using bank loans for expansion, private equity for funding and expertise, and government grants for green technologies. Strengthening exports and investing in eco-friendly R&D ensures sustainability and global market competitiveness. Next, for Top Glove can rely on retained earnings for operations, facility upgrades, and automation while minimizing debt. Bank loans and credit facilities can support short-term and long-term needs. These strategies ensure sustainable growth and financial stability.
The conclusion above, we all finally know that Comfort Gloves have strong liquidity but struggle with cash flow and inventory management, while Top Gloves is operationally efficient but faces weaker liquidity and underutilized assets. And both can achieve sustainable growth by improving efficiency, cost management, and funding strategies.